It is the dream of every trader and technical analyst to be able to catch tops and bottoms. Even though we know that this is a very elusive activity, many of us still attempt to do it. In this video, we are going to show you an indicator which brings you possibly one step closer to this elusive dream of finding a top or bottom. And I would request you to watch this video right till the end, where I show you a couple of examples of how this particular indicator can help you to achieve this objective of trying to determine a top or a bottom in a stock or an index. Let us take a look at the indicator itself, which is an indicator which I called Ourvix. Now, what is VIX? VIX is a short form for volatility index. Normally, the word volatility index is associated with the volatility in the options market. And the India VIX, which is calculated from the out of the money options of NIFTY. The VIX, which we are calculating and calling our VIX indicator, is the indicator which is going to help us to determine possible tops and bottoms in multiple stocks and indices. The calculation for this is very simple. It's 100 into highest closing value in the last 21 days of the asset under consideration minus today's low divided by the highest closing value in the last 21 days. Now, VIX is a measure of the fear factor in the market. The higher the value of VIX, the greater is the fear in the minds of the option traders. In this particular case, when we talk about our VIX, the fear factor is in the minds of the bulls. Why? Because most people being bullish are afraid of the market going down. And therefore, their fear reaches a climax when the market is kind of bottoming out. And similarly, the complacence or the comfort level, which is highest when the market is topping out, is there in the mind of the bulls. So our indicator is a kind of a contrarian indicator. When it reaches a bottom, that is where we expect that the market is topping out. And when it reaches a top, that is where we expect that the market is bottoming out. However, no indicator in the world can take out an exact top or bottom unless it is confirmed by relevant price action. Therefore, this indicator, which I'm going to be explaining to you today and showing you with a couple of examples, has to be confluenced with a reversal pattern. With a reversal pattern, the presence of this indicator in a proper zone will give you great confidence in terms of the market bottoming out or topping out. Now, let's take an example of the Nifty. Now, in the case of the Nifty, as you can see that I have marked out tops and bottoms of the last several months on the chart. The bottoms are marked out by the red lines, the tops are marked out by the blue lines. And there is one black line also, which indicates a failure of the indicator. Now, if you look at the indicator which I've plotted, you'll see that whenever a bottom has occurred, the indicator is near a predefined top line. VIX has one great property, which is that the VIX is always in a trading range. There is what we call a top line and a bottom line, which in oscillators we call overbought and oversold. In this case, we do not call it overbought and oversold. We just call it the top line and the bottom line. Now, this top line and the bottom line will have values which are different for different stocks. Now, in the case of Nifty, the top line is at a level of around 7, while the bottom line is at a level of around 0.5. For other stocks like Tata Steel, like Tata Motors, like Adani Enterprises, you will have to apply this indicator. And by applying a process of trial and error, determine where the indicator is topping out and bottoming out. Now, here in the case of Nifty, we had a piercing pattern together with a peaking out of the indicator above 7. We had a morning star here creating a top where the indicator was below 0.5. Here we had a trading range with the indicator above 7. Now, this is where the indicator, like all indicators in technical analysis, failed. There will be instances when indicators will fail. In this case, we made a top and the indicator is below 0.5. Again, a top, indicator is below 0.5. A bottom with the indicator around 7. A top when the indicator is below 0.5. And again, a bottom when the indicator is around 7. The key thing to understand is that this indicator is exactly what it's called, an indicator. When combined with a reversal pattern, it gives you very powerful signals. Now, as you can see that in almost 9 cases, there was one failure. 1 out of 9 cases. The key thing to understand is the moment it goes above 7 in Nifty or goes below 0.5, you must now begin to take reversal patterns seriously. That is the key to using this indicator successfully. A second indication is in Tesla Motors, where the value of the bottom is around 5 and the top is around 30. Now, far away across the world, a share called Tesla is being traded. Sitting here in a small little room, we can determine right here where Tesla is making tops and bottoms. As you can see, the tops and bottoms are being made with uncanny precision and are being caught by this indicator. There are failures. Here there is a failure, here there is a failure. But by and large, this indicator is giving you proper tops and bottoms. Now, catching tops and bottoms, even though a great feeling, should not become an obsession. Please remember that good traders do not bother about tops and bottoms. Rather, they wait for the trend to emerge and try to take the cream out of the trend. Incidentally, I'll just stop here for a moment and remind you that we have given in our description a series of books which will be very helpful to you. Purchasing those books could be one great investment in the market. So you could look at the description and try to procure these books for your added knowledge. Now, the reason why tops and bottoms are not important is that tops and bottoms just come and go with such speed that sometimes it becomes impossible to actually catch it. This indicator is attempting to determine and assist you in trying to determine the top or bottom with a higher degree of precision than with a normal reversal pattern. So confluencing or coming together of multiple signals is a very important sign in technical analysis, which was promulgated by a person called W.D. Gann. Gann's theories is something which we shall be taking up in our later videos. So one of the key things to remember is that the fear factor is highest at market bottoms and complacency or comfort is highest at market tops, which is why the crowd is always wrong at market tops and bottoms. That is where smart money changes its stance. And as technical analysts, we have to catch the action of smart money and side with them and trade accordingly. That is all we need to do to make money in the markets. Please remember a simple thing called Occam's razor. Occam's razor says that the simplest solution to any problem is probably the right solution. So using a simple indicator like Ourvix and confluencing it with a standard indicator like a candlestick reversal pattern or a gap, we are able to determine tops and bottoms with a higher degree of probability of success than without the Ourvix indicator. With that, we end this session, and I would request you to like, subscribe, and share this video with as many friends and groups as you can. Thank you till we meet till another video.